lot of the folks on the call may have been on our other open office hours calls that we've had in the last 6-10 weeks or so. But those of you who haven't, welcome. Thanks for joining us. Do a quick introduction of who we are in terms of putting these together. So AMRI is Accelerate Montana's Rural Innovation Initiative. And we are housed at the University of Montana, along with Blackstone Launchpad, the World Trade Center, the Technical Procurement Center, as well as the SBDC Center within our region. So we're all the economic development portfolio, if you will, at the University of Montana. And AMRI is focused on two major things: direct coaching and support of innovative entrepreneurship in rural Montana, and in support of that, building the ecosystem for innovation and entrepreneurship in rural Montana. So clearly, rural is what our focus is, and we really try not to spend a lot of time focusing on Missoula and Bozeman and Helena and challenges that entrepreneurs and business owners are having in the rural locations in Montana. So just got a sign that says I was muted, but no. You're able to hear me? Looks like you are.
Yes, we are now.
Yeah, okay. Didn't touch anything there. So our focus is on rural Montana. In the last 6 or 8 weeks, we've been doing these open office hours with the goal to get information to folks around, particularly the federal programs, the PPP, the CARES Act, unemployment, so on and so forth, really to help navigate the challenges and the economic impacts that the COVID shutdown have occurred for folks across the state. So that's our role. We've also opened up a Facebook page, the Accelerate Montana the AMRI Facebook page, as well as a group that is focused on entrepreneurship and supporting of each other. So we're trying to create a place to have conversations to sort of ask those questions that you're maybe not finding answers to. So today we have Mike Green on with Crowley Fleck, and Crowley Fleck is a supporter of the AMRI program, and they donate their time and expertise programs like this, and also to individuals. So really thank you to Crowley Fleck for making this possible, and thank you, Mike, for your time coming on today and sharing your expertise. Today we're going to try to address some of the potentially many questions that you all may have around the PPP forgiveness. And as we all know, we've been waiting for this and waiting for the forgiveness guidance for weeks and weeks and weeks. And many of you actually may be in a situation where you got your PPP loan and the clock started ticking. Because we all know you have about 8 weeks, so you have exactly 8 weeks to spend down your PPP loan in the required way to be forgiven. So there is some concern about that clock's been ticking for a while for some people, and also the challenges that it's hard to get employees to come back. It's hard to hire people for several different reasons. People are feeling uncertain about coming back to work. People are getting unemployment and financially feeling okay there. So there are some challenges there, and even looking at the application for the PPP forgiveness brings up quite a bit of challenges and questions. So Mike is going to speak to some of those questions that he sees right away with clients that he's been working with and so forth, right? That in the application. So we'll spend 10, 15 minutes or so with Mike going through the application, just speaking to what he's seeing pop up. And then if you all want to, if anybody's got questions, you can type them in the sidebar there in the chat. The chat button is, you're probably familiar with it because you've probably been on a lot of Zoom calls, but it's just to the left at the bottom of the green share screens button. So just to the left of that, you can click on chat, opens the window on the right-hand side, and you can type in questions there. And Sid is on the line too. So Sid and I are part of the AMRI team. He'll look at those questions, and he's also posted up the links to our Facebook page and so forth. I also want to make one other pitch for the BEAR program powered by UM. So BEAR powered by UM is a collaborative group that's been assembled in the last few weeks between the University of Montana, Missoula Economic Development Partnership, local citizens in Missoula that are business owners, faculty members, really focusing on trying to answer direct questions for business owners. And so if you want to send questions in, if you Google Bear powered by you can find that website. There's a big button there. You can send in your questions, and there's a team of people that will directly address those questions and get back to you within a couple of days. So that's useful. Share that around. Excuse me. With that, Mike, if you want to jump in and maybe give yourself a little bit of introduction about what you've been working on, maybe the last couple of weeks, and where you find yourself given the situation.
I will. As Carl indicated, my name is Mike Green. I'm an attorney. I sit in Crowley's Helena office. So for those of you who aren't familiar with us, Crowley Fleck is a law firm. We operate in Montana, North Dakota, and Wyoming. We have about 170 lawyers spread out over 11 offices in those 3 states. And we're really kind of a soup to nuts business firm. One of my main practice areas is employment law, and so that's how I've become familiar with this PPP loan process. I also sit, excuse me, on our firm's 3-member management committee, so I'm also intimately involved in our firm's employment issues and response to the COVID-19 pandemic. So I wear the hat. I have worn the hat for about 21 years as an employment lawyer, and for the last 3 years have also been wearing the hat of a small business manager, and so that's the perspective I bring to this. We've been advising clients kind of on qualification for the loan, application for the loan, calculation of loan amounts, and now have, as Carl indicated, have been waiting anxiously for guidance on some of this repayment, on some of the repayment issues. I wanted to highlight that, the repayment loan forgiveness application came out last week. For those of you who haven't seen it, if you just Google PPP loan forgiveness, that packet will come up. You will see it's a very short application with a fairly robust set of instructions. I wanted to highlight for you a couple of the, I think, issues that have been resolved that were hotly debated in the weeks leading up to that. One of those was the CARES Act that gave rise to the PPP loan talked about expenses that were incurred and paid during the 8-week covered period. So the PPP loan, allowed you to calculate to calculate a loan amount, and then you calculate your forgiveness based on eligible expenses paid out over the 8 weeks after your loan is funded, which is called the covered period. And there was real concern among commentators about the PPP that businesses were going to, if their payment cycles were off of that 8-week and didn't properly align with the 8 weeks, that they could potentially lose the benefit of loan forgiveness if the SBA and Treasury actually interpreted the word "and" to mean "and." Fortunately, they have not. And so it's now, they've modified that a little bit, and they are going to recognize, particularly in the payroll space, they've created a couple of alternatives for businesses so that you don't have to actually alter your payroll schedules in order to get the full benefit of the payroll cost payments. And I'll talk a little bit more about that. The other issue that they've clarified is there was a salary reduction component, and the measurement period was a 3-month period. The payment period was a 2-month period. And so a lot of the commentators were saying, well, so your loan forgiveness can be reduced to the extent that you've reduced salaries by more than 25% as compared to from the measurement period to the covered period. And they were saying, well, if you're only paying 8 weeks, but you're measuring it by 12, you're always going to be less than 25, always going to be less than 75%. And the agencies have also clarified that it isn't a 1-for-1 calculation. You actually boil it down and you look at that at a more measurable or a more comparable level, and we can talk through that as well. So those were 2 of the real kind of traps for the unwary that commentators were concerned about that have been resolved by the guidance. So let me step back real quickly. I'll talk very briefly about the payroll cost calculation, and then I want to talk a little bit about the salary reduction calculation, and then we can open it up for questions. So on the payroll costs, the agencies have clarified that it really is, it's got to be payroll incurred. So it has to be, the measurement period will be what you've paid or what you're paying your employees for working during the covered period. But it will be you're going to get credit for payroll that you make, even if it falls outside of that, even if it falls outside of the 8-week period, they're not going to disallow those payments. If you pay biweekly or more often than that, so if you pay every 2 weeks or you pay weekly, you can align, you can tweak your covered period, if you will, to align with your payroll cycle. So if you pay every Friday and your loan was funded, let's say on Wednesday, on a Wednesday, your 8-week, you can push your 8-week coverage period to start on that next Saturday. So then your payroll measurement will align perfectly with should align with your pay cycle. If you pay less frequently, so if you pay, and that would include semi-monthly, which is less frequently than biweekly, if there were any questions about that. If you pay semi-monthly or monthly, then you still have to measure the wages from the date your loan is funded, but you'll get credit as long as you make the payment for that entire covered period no later than the next payday following the end of your 8-week period. So as long as you're not delaying, is the short answer, you should be getting credit on your loan forgiveness for everything that you pay for this period during your normal pay cycle. Then the other one that was confusing, as I indicated on the salary reduction, the calculation really is, it depends on whether or not your employees are hourly or they are salaried. If salaried, you calculate their annual salary based on what you're paying them for this period. If there's no reduction, you don't have to worry. If there is a reduction, you calculate an annualized salary amount and you compare those two. So long as what you paid during these 8 weeks is within 75% of what you paid prior to the coverage period, then you don't have to do a salary reduction calculation. Similarly, on the hourly wage, you actually input the hourly wage and you compare that. So if you're paying $12 an hour before and you're paying $12 an hour after, that you calculate that difference in order to determine, and if you maintained hourly salaries the same, then then you're not subject to that. And so these instructions go through a fairly robust, again, calculation, step-by-step calculation of how you do that. But again, it's an annualized. If you pay on a salary basis, then you use an annualized number. If you pay on an hourly basis, it's actually the hourly wage rate that goes into step 1 of the calculation. Other than that, I do want to cover one other piece. The other piece they've clarified. You might all recall from our earlier discussions about the PPP, the forgiveness will be reduced if you have reduced your number of employees. That's going to be calculated on an FTE count. So so this one will get you, if you reduce an employee's hours, right? So you reduce your overall number of full-time equivalents, then you'll face a reduction. But if you don't have to count employees who, you don't have to count in that calculation employees who have refused to return to work. If you've tried to bring them back and they've refused to return to work, or if you have employees who have resigned on their own or were fired for cause, you don't have to count them as a reduction. they're an exception to the reduction. And then finally, if you have reduced employees, but by June 30, you bring everyone back and you're back up to the same FTE number by June 30 as you were prior to February 15th, then you're also, there's a safe harbor and you don't have to reduce your loan forgiveness for that period. So those were the big, I think, moving pieces that I was waiting for clarification from. Other than that, I feel like this is a relatively self-explanatory application, but I also recognize that I read code sections for a living. So what may be self-explanatory to me very well may not be to normal human beings. So I'm happy to answer any of the questions that you all have.
Yeah, thanks, Mike. So just a little housekeeping for everybody. As I said at the top of the call, you can type your questions in, but also feel free to share your, unmute your mic and ask them verbally. Most people have got their cameras turned off too. You're welcome to show your faces. Don't mind it at all. But if you want to keep them off, understood. But go ahead and unmute your mic if you want to. If you can't figure that out, let me know. I think I can unmute your mic for you, each individual. You can just type in the bar on the side.
Yeah, and this is a fairly manageable group, Carl. So that may be more. Actually, just unmuting and asking orally, maybe verbally, may be more practical today.
Yeah, no, agreed. Yeah, so feel free. We have what just 13 folks on today, so yeah, easily. John, I saw you unmuted.
Yeah, I had a question. So for your actual payroll calculation, do you need to reduce your payroll by those employees making over 100,000 per year?
So yes, is the short answer. So you can only include their comp up to 100,000. So it really is, you do that on an employee by employee basis. You'll have to report. So the form requires you to report the cash comp for every employee, and that's capped at the 100. So it's the lesser of 100,000 or what actual pay. So it's done on an employee by employee basis.
Thanks, John. Anybody else? Paul, did I see you raise your hand? Or? No? Okay. I had a question, Mike, if we're waiting for others to ask. Could you explain a little better the June 30th to the February 15th? So as I understood what you said, as long as an employer brings their employee numbers back up to the same rate and number of employees that they had at February 15th, and they do that by June 30th, then they will be forgiven for that full employee amount. But what happens if their 8-week window ends prior to June 30th?
Well, it's two separate calculations. So let's say that you had, it's really two separate calculations, Carl. So you don't get to retroactively count payroll that you didn't pay, right? So you don't get to increase your expense amount, but theoretically, if your 8-week expenses, qualifying expenses, are 100% of your loan amount, the FTE, the June 30 safe harbor date, just says you're not subject to that independent reduction for FTE. So the FTE reduction. The FTE reduction is a separate calculation that says no matter how much you've paid in expense, if you reduce your FTE, let's say by 10%, you only get loan forgiveness of 90% of what you actually paid. So your actual payroll or your actual expense amount that you paid is reduced by 10%. So the FTE reduction safe harbor says, but if you are back up to 100% FTE by June 30, you're not subject to that 10% haircut. So it's a multi-factor, multi-step calculation, and it's really just cutting off that what's essentially the third check, which is the FTE reduction that is fixed by that safe harbor.
Yeah, okay. I think I follow that, but that is a bit tricky, I suppose. So if you're, one of the questions that kind of follow on question with that is, if you're an employer and you're approaching the end of your 8-week covered period and you haven't brought everybody back yet because you don't need them, you're just reopening now, you can't figure out anything for them to do, can you pay people, can you sort of load it up heavily on the back end of that 8-week period by paying people more to then have it forgiven? So essentially what you're doing is trying to do the same thing, you just haven't been able to do it within the 8 weeks. Is that acceptable?
Well, so the short answer is, under the current rules, no. There are, you can't pay advances is the short, so you can't, it has to be for time worked. It can't be for, it has to be for time actually worked in that pay period. So there's, now if you actually have, so some people had given, let's say that you provided during that period, you'd provided, you know, kind of a risk adjusted pay factor or something like that. So for employees who have returned to work, you bumped their average salary during that time period. Those payments count, but you can't pay advances on wages for employees who haven't come back yet. That's under the current law. There is actually working its way through Congress right now a bill that will expand the covered period. It's going to allow some of those, kind of in recognition that some businesses just have not been able to reopen. It's going to allow, I think, to expand the period and maybe give some different calculations. We haven't seen that, obviously haven't seen that final, but Congress has recognized that exact issue and I think is going to try to fix that. But under the current rules, you can't advance pay salary. Similarly, you can't advance pay mortgage, interest, utilities, or rent. You can't prepay, if you will, in order to up your covered expenses during that period. It has to be for amounts attributable to those periods.
What about just raises or bonuses? Are those acceptable during the period?
Yes, is the short answer. They're, as long as they're legitimate. Yeah.
And how do you determine a legitimate bonus? I mean, the worry, I think, would be that, hey, we have this free money, let's pay our managers a lot more or pay someone a lot more and the taxpayers will pay for it.
Well, I think you're going to be subject to a review and you're going to have to justify the business purposes for those. So if it's, you know, where we've seen is if you've got long-standing incentive payments, let's say you've always, in May of every year, you pay last year's incentive bonus or something like that. That's going to be a legitimate business expense. These risk-adjusted, we have seen, as I indicated, these risk-adjusted bonuses or retention payments, those kinds of things that really are tied to keeping employees. But if it's just a willy-nilly, hey, we're going to throw out these big bonuses, I think if you're about $2 million, they're going to come look at those.
Yeah, we were gonna pay our managers, you know, a couple $1,000 extra bonus, and it happened to be during this pay period. We haven't done it for years, but we're gonna do it this year.
Yeah, I think that's gonna be. I don't think it would take much for an SBA auditor to say, no, we're not gonna let that happen.
And by the way, just in terms of what the ramifications would be, then that amount would not be subject to the forgiveness. That's not like it would be an invalid, illegal use of funds or something like that. It just wouldn't be part of the forgiveness.
That's right. It wouldn't be, right. You're just not entitled to forgiveness under that. Yeah.
And so then oh yeah, go ahead, Sid, why don't you go in? Yeah.
Just a quick question from Paula. She's wondering if the rules around this will change. For example, restaurants are lobbying for 24 weeks versus 8.
Well, I kind of quit forecasting what Congress would do, but a number of the commentators out there feel like this has a very good chance. I will tell you candidly that the challenge I see is that it will require unanimous consent in the Senate because they've all left town. And so we have seen some senators who are, Rand Paul in particular, who have been willing to, for a variety of reasons, to derail some of these unanimous consent provisions. So under unanimous consent, any single member can prevent passage. So, which would require the Senate to come back in and vote. So I think that's really I think it has a very good chance of passing the House, and there's just concern about whether or not. Apparently, Majority Leader McConnell feels confident that his caucus will not object. That is the kind of the latest that I've seen, but I hadn't seen any. That was early this morning, so I'm not aware. But that's really the thought, is that there's going to be some expansion.
Thanks. I'll go ahead.
Yeah, I'll ask another one if that's okay. In terms of, can you, Mike, just speak of like what happens if all the money is not used? Is it, I mean, I know that it's theoretically becomes a 1% loan, but is there some issue with like, we'll just take out a bunch of money at a 1% loan. We may or may not use it for the purpose it's designed, and then we've got this great financing. Is there some thought that, you know, if you don't use it correctly, it actually doesn't become a 1% loan, or you get fined, or, you know, some violation of law? Do you have any thoughts about any of that?
Well, so I have a lot of thoughts about it, but the guidance that the SBA and Treasury have said is basically, so the issue, Jeremy, where that has come up is on actually, there was a whole bunch, remember Shake Shack, and I don't know if any of you followed that, where some of these large companies were accused of improperly certifying impacts or a need for this funding. And because one of the things under the application the SBA required was that you were certifying that 75% of these proceeds would be used for that 75% of these proceeds would be used for payroll protection. So but the SBA has come out to say they are more likely to determine to just require repayment of those loans, and it wouldn't qualify as a loan. You'll just have to repay immediately, rather than seeking criminal or civil sanctions now. So, you know, if you've done that, if you've taken the money and not spent it on these approved things, hopefully you'd have the cash in the bank to do that. So there's that issue, and then there's also the issue of, you know, the other big issue that the SBA injected into this process was the access to other liquidity sources. And again, that's one where it's simply not authorized by the statute. And there's been, you had to certify that you're being impacted or expect to be impacted by COVID. So as far as a fraud penalty and those kinds of things, I think their ability to go get those is going to be pretty limited. But I think particularly in the space above $2 million loans, we can expect a fairly robust review by the SBA and potential some disallowances.
It seems to me that there's going to be a lot of companies that have this idea that they're going to, you know, rehire all their employees or can keep all their employees. Maybe that actually doesn't work because of business reasons.
Yep.
And then so they'll be stuck with this money that they, you know, thought they were going to pay to employees. Now they can't. What do they do with it? Can they just keep it as a nice low interest loan? Maybe they repay it back. But I guess the answer would be, let's wait and see. And will we be told by the SBA or some federal authority that we have to pay it back? Or is that something that a business has to decide on its own, whether or not they have to pay it back and whether it qualifies as this like 1% 2-year loan?
No, I think the forgiveness application, the SBA will have to tell you that they've determined that your application was not valid. So it would be the SBA coming in. The lenders will be policing this a little bit, but I don't know. My guess is that we're not going to see lenders who are disallowing or saying, because they've approved them on the front end. So I don't think it'll be the lenders. It'll be the SBA that would be making that determination. And again, I think that assumes that Congress doesn't provide some relief through a new act.
We got a few more questions in the sidebar. You got one teed up, Sid?
Yeah, we got a question from Barbara. Barbara says, I own the property and buildings for vacation rentals, but the operating entity, which is the recipient of the PPP, is an LLC. The LLC pays me for rent for use of buildings and facilities. Is the rent payment to me personally considered a valid PPP expense?
So it's from the LLC, assuming that the LLC is filing a return and the IRS has not disallowed those rent payments. Those and the LLC and the recipient of the rent are separate taxable entities, are not taxable, but taxing, tax entities that should be allowed. Now, again, assuming that's in the normal, the rents are in the normal course and consistent with the pattern and practice that you've established previously.
Great. There's no follow-up to that one. We can move on to Paula's question. So the amount of leeway the bank that you got it from, so I guess the lender, has in interpreting or determining forgiveness is 1%. I have found nothing that specifically outlines this calculation. Is it 1% annually, 1% monthly? What is the formula?
Amount of leeway. Oh, well, so it's two questions, I think, is how I'm reading this, Paula. So the first one is, I think the bank will have significant leeway for loans under 2 million. Those are going to be kind of subject to a random audit. The banks will have leeway and again, in determining the forgiveness under the for all loans, but the SBA is going to audit. They've indicated they are going to audit everything in excess of 2 million in loan proceeds. So but the guidelines, as you'll see from this application, the guidelines are pretty robust. So there's not, I guess there's not a lot of leeway, if you will, from the banks. The substantiation requirements are set forth in here. And the formula are all set forth. So it's really going to be fairly arithmetic as far as applying this. As far as the 1% rate, it's a 1% annual, that's an annual rate. So it'll be, I assume it'll be calculated under the same as any other SBA loan. So it's just the 1% is just the interest rate and it's an annual rate.
If I might ask a quick question there as well. So, but there's also a 6-month deferment. Is there a 6-month deferment option on that, or is essentially that you can defer the first 6 months of payments?
You defer the first 6 months of payments, and the 1% does not begin to accrue until the end of the 6-month deferral. Right, on the loan amount. Let's bring it back to Barb's. There's a specific FAQ, and if I can't, I was trying to find on the related party rants, and I'm not able to find it right now, just offhand. But I'm confident in my answer. I just can't point you to the FAQ right now.
We got another one there. Are you on that one, Sid?
Yeah, just a quick follow-up to Paula's question. If you pay back within 6 months, is there no interest?
If you pay back, yes, that is true. There is no interest if you pay back within 6 months.
Perfect. There are just no follow-ups. People can go ahead and jump in, but we'll move on to Della's question, which is a good question. For employees that make tips, can you pay them tips equivalent to what they would have made in the past?
I'm sorry, I take it that means that maybe no one's coming into your restaurant, so no one's actually doing tips, so you're giving them an extra amount of wages in order to get them up to what they would have made with tips. Is that the point?
Yeah, so the tips would not have been, I mean, I've not seen anything addressing that. So this actually goes to the question about, is this a legitimate increase in salary for the employees? And my opinion would be that it is, but I've not seen any guidance from them on that. But clearly you are incurring that expense and paying it out to your employee.
Then another quick question from Paula. How would you define retention bonus?
Paul, maybe to articulate that a little bit. So if you're saying you want to pay somebody a bonus to keep them on, essentially, because whether they're feeling worried about starting work again or they're leaving for something else.
Yeah, I think that's the, again, we don't have a ton of guidance out there on that, but I do think, there's, oh no, that's, sorry, yeah. She just clarified, she's asking about when we were talking about advances and those things. Again, I think it's going to be, there's going to have to be some justification where your employees are requiring that to return, or if you've had a subset of employees that you've decided, you're paying a lot of your employees to stay at home, but those who are coming in, you're paying a pay differential, right? That's because a lot of businesses who've gotten the PPP have continued to just pay salary while their employees were either not working or working reduced hours on a telework basis. So those are the kind of risk-related bonuses. And again, the retention bonus, there's not much guidance out there, but if there's a legitimate bonus that where employees are looking at saying, I'm not, if you're in a high risk industry or something like that, and you're going to just have to substantiate the basis for making those payments. I don't know that you can, there's a set answer for that.
Any other questions? Jeremy, you got one?
Yeah, I always do, sorry. Mike, it seemed in the application for the loan itself that the FTEs were calculated based on an average number of FTEs over a 1 year period. And the forgiveness of the loan is going to be determined based on the number of FTEs you have at the end of the forgiveness period, or at the end of that period of the pay period. Compared to, I'm assuming the number of FTEs that you had at the beginning or as of February 2020, but the FTEs in the application were calculated based on an annualized number. So what I'm wondering is, for those companies that are kind of seasonal, that employ, some people now, fewer people in other times of the year, is that how are they going to calculate those FTEs? Because I could see, in fact, I'm well aware that there are some companies that have an average number of FTEs that are higher than the number of FTEs that they're going to have at the end of this period. So if they use the February date, they would have more. It would look like they were bringing more people into work. But if they use their average annual FTEs, it would look like they're not bringing more people into work. If that makes sense.
Yeah. So there's there were a number of different calculations. The annualized number that I think you're talking about, Jeremy, was the SBA rule on how you calculate the number of employees for purposes of determining whether or not you were at or below 500 employees. And that rule actually is a headcount rule, not an FTE rule. And so what that rule says is, the SBA rule says number of employees, full-time and part-time, counted, and it's essentially what we call a head count, as opposed to an FTE calculation. There's been, in fact, the repayment application seems to depart from that, and the CARES Act departed from that. There was a lot of guidance out there where the SBA said you had to follow that rule. They revoked that guidance, and then the applications were actually then kind of processed. Employers were submitting applications based on head count employee headcount on the date the application was submitted. And that's what, so you have to report that number actually on this repayment form. So it's head count, full-time, part-time, all counted as, one per employee. That's
So
the
just to
employee.
clarify, so just to clarify, on the forgiveness application, you will report the head count of employees on the date that you made the original loan application.
Right, and then
Right.
yes, is the short answer. That's one of the things you report. So I'll come back to the FTE because the FTE calculation is separate. So there was how do you qualify for the loan? How many employees do you have for purposes of meeting the 500, right? And then there's the FTE rule, which talks about how do you calculate your amount of loan, any reduction to your loan forgiveness. The FTE numbers were the number, you looked at a shorter time period, and there were there's actually 3 alternatives provided. You can either use the time period from February 15th of 19 to June 30 of 19, and you just calculate your average FTE for that period. So, or you could use your FTE, your average FTE for the months between January 1 and February 29 of 2020. So those were the 2 alternates. Or if you were seasonal, you could pick any 12-week period, kind of that, where you would have had employees on staff, and then it get between February and June of 2019, or January and February of 2020, or between May and September. So let's say you're a fishing outfitter and you only have employees from May to September, so you would have done your FTE calculation for that time period. That's your starting FTE, and then you do another FTE calculation for the 8-week covered period.
And just to be clear, that is for purposes of the loan forgiveness application. Is that right? You will have 2. So essentially, you'll have 2 numbers on the loan forgiveness application: a start number and an end number.
You're going to have, relative to employee count, you're going to have 4 numbers. You're going to have the number of employees at the time of the loan application, the number of employees at the time of the forgiveness application. That's a head count number. Then you're going to have FTE for the measurement period and FTE for the covered period. So there's actually four separate employee counts, if you will, that are included on the forgiveness application.
Mike, when you say FTE numbers, the 2 FTE numbers, one for the measurement period and one for the covered period, is that the same as saying before and after, or that's the same as saying last year versus this year, or something like that?
Well, I would say, the measurement period, you have to pick the measurement period, I guess, and there's options. So it is before, it's kind of whatever, it's one of these statutory periods that you pick before the pandemic as your measurement period.
Yeah, and sorry to keep harping on this, but if the application that was submitted initially had a number of employees that was calculated based on some sort of annualized FTE, I take your answer to mean that, 1, that was probably the wrong way to calculate it because it should have been head count, and 2, you can probably use the corrected numbers on your forgiveness application.
Yes, is the short answer. Actually, it's because the application was confusing, to be honest. It was not entirely clear.
Yeah.
And the guidance was not clear. Depending on when you applied for the loan, the guidance was all over the board. So
Totally.
I think that, Jeremy, that's the short answer is yes. You should use the numbers as you understand them today to report on each of these separate lines. Because there was just one line, there was just one line on the, there was one line for employee count on the application, and it looked like they wanted FTE. So,
and I think some people were doing it with FTEs, and other people were doing it other ways, and some people were using a certain period, and other people were using a different period.
Right. The only people that I'm concerned about, I had a couple of clients that were in, very close to the 500. So that number became very critical. If you're well under 500 employees, then that number, the number that those numbers are really not as critical.
By the way, if you were close, let's say you had 475 employees, so you were within the authorized, number, and then can you not go over, and then you're in this period where you're supposed to be hiring people and promoting, economic development and wages and employment and consumerism. Are you not allowed to go over 500 then if you were below 500 to begin with?
So my position is under the language of the statute, it was the number, it was your head count on the day you applied. That was the measurement. And that's actually, just so you know, that's actually supported by guidance that came out relative to the FFCRA, which was the prior act relative to there was a 500 employee count for that act, right? Covering the emergency leaves and paid sick leave. So the language is very similar. And so my position is the CARES Act did not follow the SBA rule. It did not incorporate that year's average or anything like that. So, I mean, it's the employees at the time of the application that determined your eligibility is my position. I've seen no guidance no written guidance from the SBA that would contradict that. So if you go above 500 during the covered period, if you were legitimately at 475 and happen to go above 500 during this period, there's nothing that should disqualify you.
Yeah, good for you.
There's a question in here from Paul, maybe following up on the bonus question again, but essentially I think it's asking, she says, so going back to where you said, so you pay them $1,000 to promise to come back to work, retention bonus, and then they don't, but you paid it out. So does that count?
I would say not, because that was not for work. They didn't actually stay and it didn't stick, so it can't be counted as wages. I think that would at that point probably be gratuitous.
Yeah, interesting, Paul, to see why they didn't come back. But yeah, that's a tricky one.
Well, I will say one of the challenges that Congress is recognizing is with the $600 a week in unemployment benefits, a lot of employees do not want to come, are not wanting to come back. They want to ride that $600 through the end of July. So I think that Congress, they accomplished their goal, which was to make sure people had money in their pockets and were not impacted by this. But Senator Graham and some of those who are raising concerns about people were wanting to return to work seem to be, have been proven right. I'm sure you all have seen them. There's articles all over where employees are mad that their employers went and got these PPP loans and want them to come back.
So here's a question along with that, and see if other people have thoughts on this. So last week we had a conversation about unemployment, and sort of laid out, Kellyanne from the job service here in Missoula sort of laid out the 4 different unemployment options or programs, essentially under the federal program. The regular unemployment insurance that you typically apply for, you might get rejected from that for some reason, but then you're likely or potentially be able to collect on the pandemic unemployment insurance program. If you're qualified for at least $1 of that pandemic program, you then get the $600 kicker. So if let's spread the needle here for a second with me. If your employer says come on back at almost your full rate, but not quite your full rate. Kelly was saying that if you're not fully employed, then you still qualify for a very small amount of unemployment, thus you get your $600 kicker. So for that employer, could they make that calculation and say, well, I'm not paying them like I did at the February 15th time, but I'm still going to be at 75% of my loan amount paying out if I bring everybody back almost full time, and which allows them to continue to collect that unemployment and $600 kicker.
I mean, the short answer to that is I think they can. Now, I don't know that the unemployment pay processing and all of that has worked as slickly as everyone thought that it would. And let me just also say that kind of the states in our region, the other piece why that is so, that's a little bit odd. Montana is one of a handful of states that that provide unemployment for reductions in hours. So most states won't do that. You actually, it's kind of all or nothing. You have unemployment, or you have what are called short time agreements, in which employers, there's a reduced benefit that's paid out for employers but it's paid out, and there's restrictions on the employers for reduced hour payments. Those folks in those states do not get the full $600. So Montana, that's kind of a unique aspect of Montana's unemployment system, where that we pay out traditional unemployment benefits for reduced work. But I think those are out there. And Carl, you raise an issue that what's called the pandemic relief, those pandemic benefits, those are the benefits, the unemployment benefits extended to people who are not eligible for traditional unemployment. What's unclear to me is an employee who refuses to return to work. It's clear they are excluded from unemployment benefits if they've refused to return to work. What is not clear is then whether or not they're excluded from the pandemic benefits. And I'm not sure that question has been answered.
Yeah, I think last week the idea was they would not be, but
I think that was clearly, I think that's the, when the president has been making the statements about you shouldn't get unemployment if you don't return, and Department of Labor has started issuing that guidance, I think that's clearly their goal. I'm not entirely sure that's what the act says, though. So they may have that little tricky statutory issue.
Right. Well, I bring that question up just in the interest of sort of having a conversation between employers and employees. There could be some cases or many cases where they could navigate that by saying, well, come back to work nearly full time, we can get going. They can have the PPP forgiveness potentially. They can be in line to pay down their PPP and thus get it forgiven, but the employees could potentially still collect the $600 as well for the short period of time that it's still going to be available. So
Right.
Maybe could you alleviate that tension of making more by not going back to work?
Yeah, I think the short answer is I think you could, and particularly for employees who were already in the system, it seems like that would be fairly easy, because they could just report that we're now employed, but it's at less than full employment, so I'm still entitled to the benefit.
Right. Yeah, I haven't actually talked to anybody who's trying to navigate that particular piece, but it was a topic last week as well. It came up.
Yeah, and again, that's because Montana is so unique. If you read an article about Washington, that's not how their system works. So the coffee kiosk operator, for example, in Washington, whose employees were refusing to come back, that triggered some of these articles. Washington has a different system, so that was they just had a different aspect.
Sure.
So Paula asked a follow-up question about the $1,000 retention bonus. If it was, it just says if you paid $1,000 retention bonus and they didn't come back, it would not be included. But if they did come back, the $1,000 really still is not for work that they've done, so it shouldn't count. And the short answer to that, Paula, is if you're actually paying for, if you're issuing comp for time during which an employee is working, the wage and hour division is going to consider that wages, even if it doesn't necessarily tie out to actual work. If it's for a period during which they're working, that would be considered wages under the law, and more importantly, is going to be counted for purposes of calculating, base rates for overtime and all of those issues. So it would be, if it's for time that they're actually working, it would be considered wages.
Maybe as a clarification here, Paula. So if the person doesn't quote unquote come back, if they're still an employee, but they're at home and you pay it to them and they're actually still getting payroll, then in that case, I think, Mike, it would count. Is that right? Even though they're not working in the establishment, they're at home.
Right. I think that's, I think that
But if they're
If
not
you're paying
working,
them other wages, right? But if you just paid them $1,000 and didn't, you can pay people you can pay people even though they're not working. I mean, that's what in fact, a lot of employers are doing under the PPP. That's a different issue. But if you're trying to pay a bonus for people who aren't working, I think you're going to have trouble with the SBA.
we're at 3 minutes to the top of the hour. So I don't know if there's any last questions. Yeah, Jeremy says thanks. Yeah, thank you, Mike, very much for that. This is recorded. We're going to put it up. We put it up on the Bear website. We post a link to it on our Facebook page and on the Amory website as well. Those links were back at the top of the chat, right up there. If you scroll back up. So shoot us any messages. If you have questions, follow-on questions, things that didn't get answered today. We're always looking to see what the next thing is, how we could be of help to all of you. So send us some messages on what are your big questions that you need answered. But Mike, thank you again, and really appreciate the work you're doing for everybody in Montana.
Yeah, thank you guys. I appreciate you taking the time. Hope it was helpful.
Absolutely.
Thank you.
All right, thanks.
Take care, everybody. Have a good afternoon.
Bye.
Thank you.